let's get a bit of a sense of the state of the economy and the markets with Michael Famuruti, who is an economist at Vetiva Capital Management. He's joining us from downtown Lagos via Skype. Good morning, Michael. It's good to see you. Thanks for coming through on the program.
Morning, boss. I'm pleasure to be here.
Yeah, thank you. Good, but it's been quite some time. But let's start with this latest Eurobond that your colleagues at FBN Quest says, well, Nigeria needs this money, $2.5 billion mid-November. At least in about 30 days from now, we expect the DMO to hit the global marketplace for this dollar borrowing. What's your take on this?
Well, yes. So in terms of Nigeria needing the funding, that's pretty true. Whilst all revenues have not been too bad this year, because production took a while to come up, generally federal revenues have underperformed, and because of that, the government has had to borrow a lot more in the domestic bond market, which obviously has the issue of crowding out. So in terms of funding, they haven't tapped into the Eurobond market enough. Yes, they raised $1.5 billion this year, but that was for the 2016 budget. And for 2017, all we have really seen is a $300 million diaspora bond. So it's definitely true that if the government wants to properly finance its fiscal activities, then it should really be looking at external borrowing a bit more, which obviously they've stated they intend to do.
In terms of the broad economy, what are the headlines for you, Michael, in the fourth quarter? What are you looking to see? I know budget is one of it.
Yeah, so the budget, and I guess we'll just add to that the success, hopefully, of these borrowing plans. So apart from the 2.5 billion Eurobond, which has been mooted, the Ministry of Finance has also suggested converting some of its treasury bills, about $3 billion worth, to relatively medium-term external finance as well, probably in the form of a shorter-term Eurobond. So that's something that is really going to be impactful, not just in terms of how it affects government borrowing costs, but also in terms of how it affects the capital markets in the country. As we know, current monetary policy stance has been relatively tight. The CBN has been mopping up systematically. We have seen a bit of rate reduction in the last month or so, but whether or not that treasury bill conversion goes through would have a significant impact both in the wider economy but also in the capital markets.
In terms of the markets, where do you see, where would you want to see significant action from the monetary policy side of things or from the fiscal authorities in the final 3 months of this year?
Definitely from the fiscal side. I think in terms of monetary policy, my view is that it's being handled pretty well. They've not taken any drastic actions. Yes, there are concerns about federal government funding, inflation, and growth not being as strong as expected. But generally, given the situation they find themselves in, given the competing claims, I think this maintaining the status quo going into 2018 is the most desirable outcome. That really puts the pressure on the fiscal authorities to ensure that spending is ramped up, but not just spending in terms of paying salaries, but spending in terms of trying to boost demand through those social welfare schemes, through infrastructure spending, but also in getting some of the larger projects off the ground, such as the special economic zones that were planned at the start of the year. Traction in that area is one thing that I'm hoping we see before the end of this year.
Now let's pause a second, Michael, here. Look at where we are. From 2016 to 2017, we don't have the 2018 budget yet, but we keep budgeting extensively and quite large, well, by the size of what we have in capital expenditure, what we call CAPEX. But if you look at what we're spending in 2015, 2016, and into 2017, in total, by the end of this year, we'll still be spending less than $500 billion naira, despite the fact that we budgeted about 1.2, close to 2 trillion out of the total portfolio. Do you think this amount of spending will be enough to achieve some of the things you've just talked about, create jobs, fix the social infrastructure that we need?
No, I think the biggest indication is that the federal government itself planned about 2.5 trillion naira capital expenditure. That is a signal of the size of the task it believes it has in front of it. So if ultimately what is spent is only a trillion naira, then it goes without saying that naturally you would not expect the level of impact desired. If we are in that situation where actual spending falls short, then we have to shift our focus to, okay, how exactly were these funds spent? Because even under capital expenditure, there's all sorts, right? There's paying for computers and factories, there's building roads, and there's like I said, trying to kick off some of these special economic zones that we do believe would have a significant impact in boosting this country's industrial base in the long run. So if spending does fall short again, then it becomes even more critical where the funds are directed to get maximum bang for your buck.
Yes, where the funds are directed. But again, let's talk about where the money is coming from. So we're doing aggressive foreign borrowings. We have shortfall in revenue locally. Oil is looking very good, thanks to the folks in the oil market. But of course, tax is still one matter that we've not been able to actually aggressively move on. So do you think PPP should come in here very quickly? Do you think we need to sell some assets to bring in the critical money that we need to pump in?
So in terms of PPP, I think that's a no-brainer. The question always comes down to, okay, what projects are you doing? Is it airport concessioning? Is it roads? Or is it rail? So PPP is always a viable option. It's just a matter of in which projects and what model are you going to use? Because generally, we've been hit and miss in terms of selecting the right model for each project. In terms of selling assets, I do generally think that this is still not a good time to sell some of the assets that we are probably discussing implicitly. At the same time, if these are revenue generating assets, then the natural thing for me would be to borrow against them, because in the future they should generate revenue. So rather than selling some of your gas assets, how about you generate borrowing from those right now, and then you ensure that the production in the next 5 to 10 years is sufficient to account for that borrowing, because that's a more prudent method than just selling these assets off at a time when you probably not get as much value for them as you would like.
Okay, Michael, we appreciate that. Let's sweat the assets rather than sell them. Michael, please stick around with us. We need you around at 1:30, still on the show to speak more specifically to the third quarter markets. We'll come back to you. Michael Famaruti from Vertiva Capital Management is the economist.